Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production, or recognition of any of these patterns, levels, analysis, or any related items on these, my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that, Chicago soybeans. Okay, so first a quick look once again, at my longer term monthly charts. As I highlighted 6 weeks ago, there had been some very interesting actions taking place. So the market, since as far back as the low seen in August 2024 till October 2025, built a sideways action. I noticed this action 46 weeks ago, and I will expand on that part shortly, but I just wished you to see that this sideways action had a breach on the upside in October 2025, and the market has tried stabilizing over this sideways action, originally between about the 2019 to date uptrend, which is currently at 982 and a quarter, up to the topside congestion in 1105.5 area. Initially, we seem to have established a basing action around a triple bottom formed over August 24 to August 25, and this is where a caution I gave back last year applies, and I quote, "Once again, as I've done for quite a few weeks now, feel obliged to caution you on the possibility of a false break higher," end of quote. Now, prices failed at the MOVE 3-year moving average, which is currently at 1163 even, back in November, and again in December last year, and have fallen away in December with a combined monthly bearish engulfing pattern, plus a bearish open and close long black Mariposa. This has led to the market heading back within the original sideways action, for all the implications that may have. The most immediate thing to consider is the possibility that prices may head down to the two targets below for the 2020 to 2024 very large head and shoulders top pattern type. I'm not necessarily sure about that just yet, but that's where the immediate implications are. You can see the bright red neckline highlighted for this pattern overhead, which is currently at 1213 and 3/4. Thus, the primary target X is down in the 907 even zone, and the secondary harder to reach target X1 is down in the 624 zone. Please note, these are very, very, very long-term targets and should always be considered thus. Back to my daily charts, and you can see that same bright red neckline close to the top of my daily chart. Now, in addition to this bright red neckline, 46 weeks ago, I highlighted here on my daily chart a bright pink July 24 to October 25 rectangle pattern, which you can still see, which is currently 982 and 3/4 to 1107 and 3/4. This is the pattern outline of the basing pattern I spoke about on my earlier monthly chart. This pattern had worked until late October, when prices punched up through the upper pink trend line, taking most of November 2025 to stabilize over it, and interestingly in the process forming a small lopsided head and shoulders top pattern. More on this pattern shortly. Now, 9 weeks ago, prompted by the bullish action on Winnipeg canola the previous week, I drew a dark blue mid-December 24 to early August 25 bullish Andrews pitchfork. What is noteworthy about this pitchfork is the effect the dark blue middle line above, which is currently 1185.5, had on the market. It was a cap, a pierced cap, I admit, but still a cap over most of November last year. This caused the market to develop into perhaps the most interesting short-term pattern here, the previously mentioned late October to mid-December 2025 head and shoulders top. 8 weeks ago, I said about this pattern, and I quote, "This is not fully justified, as prices have only yesterday dipped below the neckline. Thus, I cannot lay out targets below as yet, but I can set out some potentials. Hence, a primary potential would be down in the 1107 zone, just around where the bright pink broken upper trend line lives, whilst a secondary potential, hard to reach potential, would be down in the 1080 zone. Please note, these are just potentials at this time, as we sit with only one close below the neckline, and there is still a significant chance for a false break on the downside," end of quote. 7 weeks ago, I added, and I quote, "This pattern is fully justified, with the market already reaching the primary potential now target at 1107 and the secondary hard reach potential at 1080, area becomes target." Now, and that's the end of the quote. 6 weeks ago, prices reached the secondary target, and I hoped at the time for three things that might erode the immediate bearishness. They were: 1, the old pink breached upper trend line; 2, the 50% Fibonacci line of the May to August 2024 move at 1098; and 3, the green short medium moving average, currently 1092 and a quarter. They did not erode, and in anticipation of such event, I also added at the time, and I quote, "If it doesn't, you will have little support until the 50% Fibonacci line of the August to date move at 1067 and a quarter, and the nearby change gap 1063 to 1070 and a quarter." End of quote. The market duly fell to these levels and overshot on the downside. Again, I anticipated this when I said 5 weeks ago, and I quote, "And I would add to the mix the rising mauve medium moving average, currently at 1076.5. Now, if these give way, which is possible, then we have nothing until the long moving average, which is currently 1055 and a quarter, and the dark blue lower time, currently at 1066.5. What is interesting about these two is that they are in the midst of congestion from earlier this year, between about 1061 down to 1020 on the wide, and would likely be a suitable resting point should the 50% Fibonacci line at 1067 and a quarter fail to hold, which it might." End of quote. Well, we saw that in early and middle January as the long moving average and the rising dark blue lower time eroded the bearish incentive and left behind a new pattern. A small mid-December 25 to mid-January 26 double bottom. Last week prices closed above the midpoint of the double bottom at 1067 a quarter and over the mauve medium moving average. Thus, this small double bottom pattern gave us the immediate primary target X up in the 1096 area, with a secondary harder to reach target X1 up in the 1105 area. Both of these targets puts the market up in the area of the bearish influences of the green short medium moving average and the 50% Fibonacci line at 1098, though still just under the bright pink upper trend line. Yesterday prices reached the primary target at 1096 and are now negotiating the green short medium moving average and the 50% Fibonacci line in trying to get up to the harder to reach secondary target X1 up at 1105. Chicago soybean meal. The peak in late December last year ended up making a small cat's ears pattern, and that's a type of a double top pattern that forms after a steep drop, such as the one we had in late November and December last year. The primary and secondary targets for this pattern were reached 2 weeks ago when prices reached down through the 50% Fibonacci line and mauve medium moving average combination and halted just under the gold flatlining long moving average, currently at 293 even, down at the congestion at 290.80, which is within the big old April to August 2020 congestion between 282 to 300. I said about this congestion zone 6 weeks ago, and I quote, "Is this enough to hold it? I'm not sure, but it's enough to make the market think about holding it, as further down we have the mauve medium moving average and the long moving average. Thus, from the 50% Fibonacci line at 298 down to the long moving average is where we will see if prices can hold this zone." End of quote. This move down has left us with some interesting possibilities, as the whole mid-December action from the cat's ears pattern to date can be either regarded as a bear channel, which would be 287.20 up to 303.60, or a possible descending expanding wedge pattern, which is from 283.80 up to 303.60. I'm more in favour of the bear channel idea right now, as I'm not a great fan of descending expanding wedge patterns, but we shall see how this develops. Finally, this commentary would not be complete without my discussing a portion of my commentary which I've repeated for 138 weeks, so for over 2.5 years. It is the annual key reversal seen here at the end of 2023. I said back then, and I quote, "I now only need to remind you once again of my words when I pointed out that Chicago soybean meal was about to have that rarest of patterns, an annual key reversal down. This duly came about at the end of 2023, and we've been living in the shadow of this pattern ever since. I've also added ever since, and I quote, there is only one thing you take away from any of my musings, let it have been those words. End of quote. For over 2.5 years, the shadow of that pattern has darkened the skyline of this market ever since. Chicago soybean oil. 11 weeks ago, I said, and I quote, with all the activity in the soybean complex, it was time I finessed this daily chart to show a better and clearer view of what was going on. Thus, the key pattern here is the newly expanded, sorry for the pun, the newly expanded dark blue April to date, so that is April last year today, April to date ascending, expanding wedge pattern, currently 53.33 to off the top of my daily chart. End of quote. This pattern, specifically the dark blue lower trend line, has until mid-December last year acted more as an attractor than ascending, expanding wedge pattern trend line. Back in September/October last year, the market started growing a new pattern, a bright red mid-October to mid-December expanding wedge pattern. Neither an ascending nor descending, just an expanding wedge pattern highlighted in bright red on my daily chart, and that's currently 47.66 to 54.19. Now you could argue that this is a complicated double or even triple bottom, and I could see your point. It's just that I favour the expanding wedge pattern as is a better fit for the market's actions. Going back to that triple bottom idea for a second, we did form over late December last year and the very start of this year a double bottom from which we have already reached the primary and secondary targets topside, as well as retiring the secondary downside targets for the November base double top, as the primary ones, when they were reached, were enough. What this comes down to is what I set out to do right at the beginning of this section of commentary, and that is, and to quote, to show a better and clearer view of what is going on, end of quote. I think this expanding wedge pattern may just be that. Now, last week we closed above the bright red upper trend line, though in truth we have seldom let go of it ever since we breached the upside. However, enough time has passed to at least lay out some potential levels topside for this breach, which might become a break. It's just a breach at the moment. Thus, a primary potential will be up in the 57.10 area, the secondary hardest reach potential up in the 59.05 area. As yet, these are not targets, not yet at least, just potentials, but they are worth considering. Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.